Question 1. An investment advisor representative, IR, discovers that a client, who is a non-accredited investor, has invested in a private placement offering that requires accredited investor status. The IAR was not involved in the original recommendation. What is the IAR's most appropriate action? A. Report the client's investment to the state administrator immediately. B. Advise the client that the investment may be unsuitable and discuss potential recourse, while adhering to firm policy. C. Inform the client that since the IAR was not involved, no action is necessary. D. Help the client find a way to meet the accredited investor criteria retroactively. Answer: B. Advise the client that the investment may be unsuitable and discuss potential recourse, while adhering to firm policy. An IAR has a fiduciary duty to their client, which includes addressing suitability concerns even if the initial recommendation was not their own. Advising the client that the investment may be unsuitable, explaining the implications, and discussing potential recourse options, such as rescission if available, while following firm procedures, is the most appropriate action. Reporting to the administrator without the client's consent may violate privacy, and suggesting retroactive qualification or ignoring the issue would be unethical and potentially illegal. The practical takeaway is that an IAR's fiduciary duty necessitates proactive steps to protect client interests upon discovery of potential problems, regardless of who initiated the problematic investment. Question 2. Under the Uniform Securities Act, which of the following is generally excluded from the definition of an investment advisor? A. An individual who provides financial planning services for a fee. B. A person who offers advice on securities through a widely distributed newspaper column. C. A firm that manages discretionary accounts for clients for a quarterly charge. D. An entity that charges a separate fee for providing a list of recommended stocks. Answer: B. A person who offers advice on securities through a widely distributed newspaper column. The Uniform Securities Act typically excludes publishers of bona fide newspapers, news magazines, or business publications of general and regular circulation from the definition of an investment advisor, provided they do not render personalized advice. The key is the general and regular circulation and lack of personalized advice, which distinguishes them from those offering specific investment guidance for compensation. All other options describe activities that would generally fall under the definition of an investment advisor, involving personalized advice for compensation. This exclusion acknowledges that general market commentary differs significantly from tailored investment advice, thus requiring different regulatory oversight. Question 3. Which of the following statements about mutual fund sales charges is most accurate? A. Class A shares typically have a front-end load and lower 12b(1) fees. B. Class B shares primarily charge a level load annually. C. Class C shares have a back-end load that declines to zero over time. D. No-load funds can charge 12b(1) fees greater than 0.75% annually. Answer: A. Class A shares typically have a front-end load and lower 12b(1) fees. Class A shares are characterized by a front-end sales charge, low D, paid at the time of purchase and generally have lower ongoing 12b(1) fees compared to Class B or C shares. Class B shares typically have a contingent deferred sales charge, CDSC or back-end low D, that decreases over time and higher 12b(1) fees, often converting to Class A after a set period. Class C shares typically feature a level load, consisting of higher 12b(1) fees and sometimes a small, short-term CDSC. No-load funds must have 12b(1) fees of 0.25% or less to be designated as such, meaning they cannot charge fees greater than 0.75%. Question 4. An investment advisor, IAE, has discretionary authority over a client's account. Which of the following activities would always require specific client authorization, even with discretionary authority? A. Purchasing a different security than previously agreed upon. B. Changing the amount of a security to be purchased. C. Changing the type of action, buy or sell. D. Liquidating the entire account. Answer, D. Liquidating the entire account. Discretionary authority typically grants an IA the power to determine the ABC of a trade. Asset, what security, amount, how many shares/units, and action, buy or sell. However, liquidating an entire account, even with discretionary authority, generally requires specific client authorization because it fundamentally alters the client's investment position and objectives. This action goes beyond the scope of typical day-to-day trading discretion. It is vital for IAs to understand the limits of their discretionary power to avoid violating their fiduciary duty and regulatory requirements. Question 5. An investment advisor, IAE, is recommending a bond fund to a client. The client is concerned about the fund's sensitivity to interest rate changes. Which characteristic of the bond fund would be most relevant to address this concern? A. Its credit rating. B. Its duration. C. Its yield to maturity. D. Its inflation-adjusted return. Answer, B. Its duration. Interest rate risk is the risk that changes in prevailing interest rates will negatively impact a bond's price. Duration is the most relevant measure of a bond's price sensitivity to interest rate changes. Bonds with higher duration are more sensitive to interest rate fluctuations. While credit rating, default risk, yield to maturity, overall return, and inflation-adjusted return, purchasing power risk, are important bond metrics, they do not directly measure interest rate sensitivity. Understanding duration is crucial for managing portfolios in varying interest rate environments. Question 6. Under the Uniform Securities Act, an agent is defined as any individual who represents a broker-dealer or issuer in effecting or attempting to effect purchases or sales of securities. Which of the following individuals would generally not be considered an agent? A. A salesperson for a broker-dealer who solicits mutual fund purchases. B. A principal of a broker-dealer who supervises agents and occasionally executes trades. C. An employee of an issuer who sells the issuer's exempt securities to the public. D. An individual who provides clerical support to a broker-dealer and does not solicit clients. Answer, D. An individual who provides clerical support to a broker-dealer and does not solicit clients. An individual who performs purely clerical or ministerial duties for a broker-dealer and does not engage in soliciting or effecting securities transactions is generally excluded from the definition of an agent. The definition of an agent specifically focuses on individuals involved in the actual sales or solicitations of securities. Salespersons, principals involved in transactions, and even employees of issuers selling exempt securities typically fall under the agent definition and require registration. Understanding who is an agent is fundamental to ensuring proper licensing and regulatory compliance within the securities industry. Question 7. What is the primary difference between a custodian and a trustee in the context of an investment account? A. A custodian manages investment decisions, while a trustee holds assets. B. A custodian holds assets, while a trustee manages them for the beneficiary's best interest. C. A custodian is always a bank, while a trustee can be any individual. D. A custodian requires a court order, while a trustee does not. Answer, B. A custodian holds assets, while a trustee manages them for the beneficiary's best interest. A custodian primarily holds and safeguards assets, ensuring they are properly recorded and transferred. In contrast, a trustee has a fiduciary duty to manage and administer assets in a trust for the benefit of the designated beneficiaries, often including making investment decisions and distributions. While custodians are often financial institutions, trustees can be individuals or institutions. neither necessarily requires a court order for their appointment, though certain trusts might. Understanding these distinct roles is crucial in comprehending the different responsibilities involved in managing client assets. Question 8. A client expresses concern about the impact of inflation on their fixed income portfolio. Which of the following investment strategies would an investment advisor, IAE, most likely recommend to mitigate this risk? A. Investing primarily in long-term, high-quality corporate bonds. B. Increasing allocation to U.S. Treasury bonds with extended maturities. C. Investing in Treasury inflation-protected securities, TIPS. D. Shifting the portfolio entirely into high-dividend growth stocks. Answer, C. Investing in Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are specifically designed to protect investors from inflation. Their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI, and interest payments are then paid on the adjusted principal. While stocks can offer inflation protection, a complete shift might be too drastic depending on the client's overall risk profile. Long-term corporate bonds and extended maturity treasury bonds are actually more susceptible to purchasing power risk because their fixed payments lose value over time if inflation rises. Recommending TIPS is a direct and effective way to hedge against inflation within a fixed income portfolio. Question 9. Which valuation method would be most appropriate for assessing the value of a company that does not pay dividends and is in its early growth stages? A. Dividend Discount Model, DDM. B. Price to Earnings, PE. Ratio. C. Discounted Cash Flow, DCF, Analysis. D. Book Value Per Share. Answer, C. Discounted Cash Flow, DCF, Analysis. The Discounted Cash Flow, DCF, analysis is most appropriate for valuing companies that do not pay dividends and are in early growth stages because it focuses on projecting future free cash flows and discounting them back to their present value. The Dividend Discount Model, DDM, is unsuitable as it relies on dividend payments. The Price to Earnings, PE, ratio requires positive earnings, which may be inconsistent or negative for early-stage growth companies. Book value per share is based on historical accounting values and may not accurately reflect the future growth potential of such a company. DCF provides a forward-looking perspective on a company's intrinsic value based on its ability to generate cash. Question 10. An investment advisor representative, IAR, is determining a client's risk tolerance. Which of the following factors is generally considered the least important in this assessment? A. The client's investment horizon. B. The client's liquidity needs. C. The client's ability to tolerate losses. D. The client's current income level. Answer, D. The client's current income level. While a client's current income level provides insight into their overall financial situation, it is generally considered less important for determining risk tolerance compared to factors like investment horizon, liquidity needs, and especially the client's psychological ability to tolerate losses. Risk tolerance is more about an investor's willingness and capacity to take on risk, which is heavily influenced by how long they can invest, how much access to funds they need, and their emotional reaction to market fluctuations. A high income does not automatically equate to a high risk tolerance. Focusing on the more direct indicators of risk preference ensures a more accurate suitability assessment. Question 11. What is the primary role of a transfer agent in the securities industry? A. To provide investment advice to mutual fund shareholders. B. To hold securities in safekeeping for clients. C. To issue and cancel certificates and maintain records of ownership for corporations. D. To execute trades on behalf of broker-dealers. Answer, C. To issue and cancel certificates and maintain records of ownership for corporations. A transfer agent's primary role is to maintain records of ownership of a company's securities, issue and cancel stock and bond certificates, and handle dividend or interest payments. They ensure that investor records are accurate and facilitate the transfer of ownership when securities are bought or sold. Custodians hold securities in safekeeping, investment advisors provide advice, and broker-dealers execute trades. Understanding the distinct functions of market participants is essential for comprehending the operational aspects of the securities industry. Question 12. Which type of risk is most directly associated with a bond issuer's inability to make timely interest payments or repay principal at maturity? A. Interest rate risk. B. Market risk. C. Purchasing power risk. D. Credit risk. Answer, D. Credit risk. Credit risk, also known as default risk, is the risk that a bond issuer will be unable to meet its financial obligations, specifically failing to make interest payments or repay the principal amount at maturity. Interest rate risk pertains to changes in bond prices due to interest rate fluctuations. Market risk is the overall risk of the market declining. Purchasing power risk refers to inflation eroding the value of returns. Credit risk is specifically tied to the financial health and solvency of the issuer. Evaluating credit risk through bond ratings is a crucial step in fixed income investing. Question 13. An investment advisor, IAE, manages a client's portfolio using a passive investment strategy. This approach typically involves A. Frequent buying and selling of securities to outperform a benchmark. B. Investing in securities that track a specific market index. C. Focusing on individual stock selection based on fundamental analysis. D. Employing market timing techniques to capitalize on short-term movements. Answer, B. Investing in securities that track a specific market index. A passive investment strategy, such as index investing, aims to replicate the performance of a specific market index rather than trying to outperform it. This approach typically involves holding a diversified portfolio of securities that mirror the composition of the chosen index, leading to lower trading activity and generally lower fees. Active management, in contrast, involves frequent trading, individual stock selection, and market timing to beat the market. Understanding these distinct approaches helps clients align their investment strategy with their objectives and preferences for cost and involvement. Question 14. An investment advisor representative, IR, is preparing an investment policy statement, IPS, for a client. Which of the following components is least likely to be included in a typical IPS? A. Client's investment objectives and constraints. B. Acceptable asset allocation ranges. C. Performance measurement benchmarks. D. Specific buy, sell recommendations for individual securities. Answer, D. Specific buy, sell recommendations for individual securities. An investment policy statement, IPS, is a formal document outlining the client's financial goals, risk tolerance, time horizon, and the investment strategies and guidelines to be followed by the investment advisor. It includes objectives, constraints, asset allocation ranges, and benchmarks for measuring performance. However, an IPS generally focuses on the overarching strategy and guidelines, not specific buy, sell recommendations for individual securities, as these are operational decisions made within the framework established by the IPS. The IPS serves as a roadmap, ensuring both the client and the IAR are aligned on the investment approach. Question 15. What is the primary purpose of requiring investment advisors to file Form ADV with the appropriate regulatory authority? A. To register individual investment advisor representatives, IARs. B. To provide comprehensive disclosure about the IA's business practices, fees, and disciplinary history. C. To report daily trading activity to FINRA. D. To register securities offerings with the SEC. Answer, B. To provide comprehensive disclosure about the IA's business practices, fees, and disciplinary history. Form ADV is the primary registration document for investment advisors, requiring them to disclose detailed information about their business, services, fees, conflicts of interest, and any disciplinary history. This disclosure is crucial for client protection, enabling potential clients to make informed decisions about engaging an IA. While IARs also register, they typically do so through Form U4. Form ADV does not report daily trading activity or register securities offerings. The purpose is to ensure transparency and accountability within the investment advisory industry. Question 16. Regarding the time value of money, which of the following statements is true? A. A dollar today is worth less than a dollar tomorrow. B. Future value calculations involve discounting cash flows. C. Present value calculations determine the future worth of an investment. D. A dollar today is generally worth more than a dollar received in the future. Answer, D. A dollar today is generally worth more than a dollar received in the future. The core principle of the time value of money states that a dollar today is worth more than a dollar received in the future due to its potential earning capacity, interest or returns, and the impact of inflation. Future value calculations involve compounding, not discounting, to determine the future worth of an investment. Present value calculations determine the current worth of a future amount, which involves discounting. Understanding this fundamental concept is critical for evaluating investment opportunities and financial planning decisions, as it helps compare cash flows across different time periods. Question 17. Which of the following would be considered soft dollars under Section 28(e) of the Securities Exchange Act of 1934? A. Direct cash payments from a broker-dealer to an investment advisor for client referrals. B. Brokerage commissions paid by a client to an investment advisor's affiliated broker-dealer. C. Research reports and analytical software provided to an investment advisor by a broker-dealer in exchange for client trades. D. Rebates on mutual fund sales charges passed directly to the investment advisor. Answer, C. Research reports and analytical software provided to an investment advisor by a broker-dealer in exchange for client trades. Soft dollars, as defined under Section 28(e), refer to brokerage commissions paid by a client to a broker-dealer in exchange for research and brokerage services that benefit the client. This typically includes research reports, analytical software, and market data. Direct cash payments or rebates, A.D., are considered hard dollars and generally prohibited or require specific disclosure. Brokerage commissions to an affiliated broker-dealer, B, are not soft dollars themselves but raise conflict of interest concerns. The safe harbor provided by Section 28(e) allows IAs to receive these benefits, provided the services are for the benefit of their clients and the commissions are reasonable. Question 18. A client is seeking an investment that provides tax-exempt income at the federal level and, potentially, at the state and local levels. Which of the following would an investment advisor, IAE, most likely recommend? A. U.S. Treasury bonds. B. Corporate bonds. C. Municipal bonds. D. Preferred stock. Answer, C. Municipal bonds. Municipal bonds are debt securities issued by state and local governments and their agencies, offering interest payments that are typically exempt from federal income tax. If the investor resides in the issuing state, the interest may also be exempt from state and local taxes, providing triple tax-exempt income. U.S. Treasury bonds are exempt from state and local taxes but not federal. Corporate bonds and preferred stock generally provide taxable income. Therefore, municipal bonds are the primary recommendation for investors seeking tax-exempt income. Understanding the tax implications of different securities is crucial for financial planning. Question 19. What is the primary objective of a qualified longevity annuity contract, QLASI? A. To provide immediate income upon retirement. B. To defer the start of required minimum distributions, RMDs, from qualified plans beyond age 73. C. To offer a guaranteed return on investment for pre-retirement savings. D. To provide life insurance coverage for beneficiaries. Answer, B. To defer the start of required minimum distributions, RMDs, from qualified plans beyond age 73. A qualified longevity annuity contract, QLASI, is a specific type of deferred annuity purchased within a qualified retirement plan, like a 401(k) or IRA, that allows individuals to defer the start of required minimum distributions, RMDs, on a portion of their retirement savings beyond the typical RMD age, currently 73. This provides a guaranteed income stream later in life, often starting at age 85, and helps manage longevity risk. It's not primarily for immediate income, guaranteed pre-retirement returns, or life insurance. CLACs address the concern of outliving one's savings by pushing out the income stream. Question 20. Which of the following regulatory bodies is responsible for enforcing the Uniform Securities Act at the state level? A. The Securities and Exchange Commission, SAC. B. The Financial Industry Regulatory Authority, FINRA. C. The North American Securities Administrators Association, NASAA. D. The State Administrator, or State Securities Commissioner. Answer, D. The State Administrator, or State Securities Commissioner. The State Administrator, also known as the State Securities Commissioner or Director, is the chief securities regulator in each state, responsible for enforcing the Uniform Securities Act, USAE, and related regulations within their jurisdiction. The SEC enforces federal securities laws. FINRA is a self-regulatory organization overseeing broker-dealers, and NASAA is an association of state securities administrators that proposes model rules and legislation, but does not directly enforce laws. Understanding the roles of these different regulatory bodies is essential for compliance in the securities industry. Question 21. An investment advisor, IAE, determines a client has a high capacity for risk but a low willingness to take risk. When constructing the portfolio, the IAE should prioritize A. Aggressive growth investments due to high capacity. B. Conservative, income-oriented investments to align with low willingness. C. A balanced portfolio that slightly favors growth but remains within the client's comfort zone. D. Educating the client to increase their willingness to take on more risk. Answer, B. Conservative, income-oriented investments to align with low willingness. When there is a mismatch between a client's capacity for risk, their financial ability to withstand losses, and their willingness to take risk, their psychological comfort with potential losses, an investment advisor should always prioritize the client's willingness. Forcing a client into investments they are uncomfortable with, even if they can financially afford the risk, can lead to panic selling during downturns and a breakdown of the client-advisor relationship. While education, D, is valuable, the portfolio itself must align with the client's emotional comfort level. A conservative approach respects the client's stated preference, even if their financial situation could support more risk. Question 22. What is the primary characteristic of a wrap account offered by an investment advisor? A. It charges separate commissions for each trade executed. B. It bundles advisory fees, brokerage commissions, and other administrative expenses into a single annual fee. C. It primarily invests in a diversified portfolio of exchange-traded funds, ETFs. D. It requires a minimum investment of $1 million and is only available to accredited investors. Answer B. It bundles advisory fees, brokerage commissions, and other administrative expenses into a single annual fee. A wrap account bundles all or most of the client's investment-related expenses, including advisory fees, brokerage commissions, and administrative costs, into a single annual fee, typically based on a percentage of assets under management. This structure simplifies fee disclosure for clients and can be appealing to active traders or those who prefer a predictable fee structure. It differs from traditional commission-based accounts where each transaction incurs a separate charge. While some wrap accounts might use ETFs or have minimums, these are not their defining characteristic. Understanding wrap fees is crucial for IAs and their clients to evaluate total costs. Question 23. Regarding federal covered advisors, which of the following statements is true? A. They are always registered with both the SEC and state administrators. B. They are exempt from all state registration requirements. C. They register with the SEC and are generally subject to state notice filing requirements. D. They only advise on securities issued by the U.S. government. Answer C. They register with the SEC and are generally subject to state notice filing requirements. Federal covered advisors are those registered with the SEC because they meet certain criteria, such as having $110 million or more in assets under management, AUM, or advising a registered investment company. While registered with the SEC, they are generally subject to state notice filing requirements in any state where they have a place of business or a certain number of clients, rather than full state registration. They are not exempt from all state requirements and do not exclusively advise on government securities. Understanding the dual regulatory structure, state versus federal, is fundamental for investment advisors. Question 24. Which of the following best describes the efficient market hypothesis, EMH? A. It states that all stocks are always priced fairly and accurately, making it impossible to consistently beat the market. B. It suggests that active management strategies consistently outperform passive index investing. C. It posits that market prices fully reflect all available information, making it difficult for investors to achieve abnormal returns consistently. D. It asserts that technical analysis is the most effective method for predicting future stock prices. Answer C. It posits that market prices fully reflect all available information, making it difficult for investors to achieve abnormal returns consistently. The efficient market hypothesis, EMH, posits that security prices fully reflect all available information, making it difficult for investors to consistently achieve abnormal returns through either fundamental or technical analysis, depending on the form of efficiency, weak, semi-strong, or strong. It does not claim prices are always fair in an absolute sense, but rather that new information is quickly incorporated. EMH generally suggests passive investing might be more effective than active management, challenging the notion that active management consistently outperforms. It contradicts the idea that technical analysis alone can consistently predict prices. Understanding EMH helps shape views on market predictability and investment strategies. Question 25. A client holding a diversified portfolio of common stocks is most susceptible to which type of risk? A. Default risk. B. Liquidity risk. C. Systematic, market, risk. D. Specific, unsystematicity, risk. Answer C. Systematic, market, risk. A diversified portfolio is designed to mitigate specific, unsystematicity, risk, which is the risk associated with an individual company or industry. However, even a well-diversified portfolio remains susceptible to systematic, market, risk, which is the risk inherent in the entire market or market segment and cannot be eliminated through diversification. Default risk is primarily for bonds, and liquidity risk is the difficulty of selling an asset without significant loss. The practical takeaway is that while diversification is powerful for reducing unique company risks, investors cannot escape the broader market fluctuations. Question 26. What is the main advantage of investing in a Roth IRA compared to a traditional IRA, assuming the investor expects to be in a higher tax bracket in retirement? A. Contributions are tax-deductible. B. Distributions in retirement are tax-free. C. Required minimum distributions, RMDs, begin at an earlier age. D. There are no income limitations for contributions. Answer: B. Distributions in retirement are tax-free. The main advantage of a Roth IRA for an investor who expects to be in a higher tax bracket in retirement is that qualified distributions in retirement are entirely tax-free. While contributions to a Roth IRA are made with after-tax dollars and are not tax-deductible, this prepayment of taxes can be highly beneficial if future tax rates are higher. Traditional IRAs offer tax-deductible contributions but tax distributions in retirement. Roth IRAs do have income limitations for direct contributions, and they do not have RMDs for the original owner until death. This tax-free growth and withdrawal feature makes Roth IRAs attractive for long-term savings. Question 27. An investment advisor representative, IR, is evaluating a client's overall financial situation to recommend a suitable asset allocation. The client is 30 years old, has a stable job, no immediate liquidity needs, and is saving for retirement. Which of the following asset allocations would generally be considered most suitable? A. 80% bonds, 20% equities. B. 50% cash, 30% bonds, 20% equities. C. 70% equities, 25% bonds, 5% cash. D. 100% money market funds. Answer: C. 70% equities, 25% bonds, 5% cash. For a 30-year-old client saving for retirement, a long investment horizon and stable employment suggest a higher capacity for risk. Therefore, an asset allocation heavily weighted towards equities, like 70% equities, would generally be considered most suitable, as equities offer higher long-term growth potential, even with greater short-term volatility. The other options are too conservative for someone with such a long time horizon, providing insufficient growth potential. This allocation allows the client to benefit from market appreciation while still having some diversification with bonds and cash for stability. Matching asset allocation to time horizon and risk capacity is a cornerstone of investment planning. Question 28. In the context of investment fraud, what does churning specifically refer to? A. Misrepresenting the risks of a security to a client. B. Making excessive trades in a client's account solely to generate commissions. C. Selling a security from an existing account to purchase a similar one, often without client benefit. D. Pooling client funds into a single, unregistered investment vehicle. Answer: B. Making excessive trades in a client's account solely to generate commissions. Churning is an unethical and illegal practice where a broker-dealer or investment advisor representative, IR, excessively trades securities in a client's account primarily to generate higher commissions or fees, without a legitimate investment purpose for the client. This activity benefits the advisor at the client's expense, violating fiduciary duty. Misrepresenting risks is fraud, selling similar securities without benefit is switching or twisting, and pooling funds into an unregistered vehicle might be an unregistered offering or a Ponzi scheme. Recognizing churning is crucial for protecting client assets and maintaining ethical standards in the industry. Question 29. What is the primary characteristic that differentiates a closed-end fund from an open-end fund? A. Closed-end funds are actively managed, while open-end funds are passively managed. B. Closed-end funds are always diversified, while open-end funds may be concentrated. C. Closed-end funds have a fixed number of shares outstanding that trade on exchanges, while open-end funds continuously issue and redeem shares at NAV. D. Closed-end funds only invest in bonds, while open-end funds only invest in stocks. Answer: C. Closed-end funds have a fixed number of shares outstanding that trade on exchanges, while open-end funds continuously issue and redeem shares at NAV. The primary distinguishing characteristic of a closed-end fund is that it issues a fixed number of shares through an initial public offering, IPO, and these shares then trade on stock exchanges like regular stocks, often at a premium or discount to their net asset value, NAV. Open-end funds, mutual funds, conversely, continuously issue new shares and redeem existing shares directly with the fund at their NAV. Both types of funds can be actively or passively managed, diversified or concentrated, and invest in various asset classes. This difference in share structure and trading mechanism is fundamental to understanding these investment vehicles. Question 30. An investment advisor, IAE, has custody of client funds and securities. Which of the following is a mandatory requirement under the custody rule? AE. The IA must provide quarterly account statements directly from the qualified custodian to the client. B. The IA must obtain a separate blanket bond for each client's assets. C. The IA must provide audited financial statements to clients annually, regardless of account size. D. The IA must execute all trades through an independent broker-dealer. Answer: AE. The IA must provide quarterly account statements directly from the qualified custodian to the client. Under the custody rule, Rule 206, 4-2 under the Investment Advisors Act of 1940, an investment advisor with custody must ensure that qualified custodians, such as banks or broker-dealers, send account statements directly to clients at least quarterly. This direct delivery provides an independent check on the IA's activities and helps prevent fraud. While IAs with custody may also be subject to an annual surprise audit, and certain bonding requirements exist, quarterly statements from the custodian are a core component of the rule. This measure enhances transparency and protects client assets from misappropriation. Question 31. What is the primary risk associated with investing in an exchange-traded fund, ETF, that tracks a highly volatile sector index, compared to a broad market index ETF? AE. Interest rate risk. B. Credit risk. C. Concentration risk. D. Liquidity risk. Answer: C. Concentration risk. Investing in an ETF that tracks a highly volatile sector index introduces significant concentration risk. Concentration risk is the risk associated with having a large portion of a portfolio invested in a single industry, sector, or asset class, making the portfolio more susceptible to adverse events affecting that specific area. While broad market index ETFs offer diversification, a sector-specific ETF inherently lacks this breadth. Interest rate risk primarily affects bonds, credit risk is related to an issuer's default, and liquidity risk is the difficulty of selling an asset. Understanding how specialized ETFs can increase portfolio risk is crucial for suitability assessments. Question 32. Under the Uniform Securities Act, an investment advisor representative, IAR, is generally defined as an individual who AE. Affects securities transactions on behalf of an investment advisor. B. Provides investment advice and is associated with an investment advisor. C. Manages mutual fund portfolios for a broker-dealer. D. Supervises the clerical staff of a registered investment advisor. Answer: B. Provides investment advice and is associated with an investment advisor. An investment advisor representative, IAR, is typically defined as any partner, officer, director, or other individual employed by or associated with an investment advisor who does any of the following: makes recommendations or otherwise renders investment advice, manages accounts or portfolios of clients, solicits, offers, or negotiates for the sale of investment advisory services, or supervises employees who perform any of the foregoing. Affecting transactions, AE, is typically an agent's role, and managing mutual funds for a broker-dealer, C, would be an agent's role. Supervising clerical staff without advisory functions, D, does not define an IAR. The key is their involvement in providing or soliciting investment advice. Proper registration of IARs ensures accountability and client protection. Question 33. When an investment advisor, IAE, calculates a bond's yield to maturity, YTM, what assumption is typically made? AE. The bond will be called by the issuer before maturity. B. All coupon payments are reinvested at the same rate as the YTM. C. The bond's price will remain constant until maturity. D. Interest rates will decline over the bond's remaining life. Answer, B. All coupon payments are reinvested at the same rate as the YTM. Yield to maturity, YTM, represents the total return an investor can expect to receive if they hold a bond until it matures, assuming all interest, coupon, payments are reinvested at the same rate as the YTM itself. This reinvestment assumption is critical to the calculation. YTM does not assume the bond will be called, its price will remain constant, or interest rates will decline. Understanding this assumption is important because actual realized returns may differ if interest rates change and coupon payments are reinvested at a different rate. YTM provides a standardized measure for comparing the returns of different bonds. Question 34. A client has expressed a strong desire to incorporate environmental, social, and governance, ESG, factors into their investment portfolio. What is the most appropriate action for an investment advisor representative, IR, to take? AE. Explain that ESG investing typically leads to lower returns and advise against it. B. Select a broad market index fund as it inherently has some ESG exposure. C. Work with the client to identify specific ESG preferences and integrate them into the investment policy statement and portfolio selection. D. Invest the client's funds in a single, highly rated ESG company to maximize impact. Answer, C. Work with the client to identify specific ESG preferences and integrate them into the investment policy statement and portfolio selection. When a client expresses specific investment preferences like ESG, the IAR has a fiduciary duty to understand and incorporate those preferences into the investment strategy, as long as they align with overall financial goals and risk tolerance. This involves identifying specific ESG criteria important to the client and building them into the investment policy statement, IPS, and subsequent portfolio selection process. Dismissing it, opting for a generic index fund, or making a concentrated investment without detailed planning would not be appropriate or in the client's best interest. Integrating ESG factors requires a thoughtful and personalized approach to ensure the portfolio reflects the client's values and objectives. Question 35. What is the primary benefit of dollar-cost averaging? AE. It guarantees a positive return on investment. B. It minimizes total investment costs by only buying at market lows. C. It reduces the average cost per share by investing a fixed dollar amount regularly, regardless of share price. D. It allows investors to time the market effectively to maximize gains. Answer, C. It reduces the average cost per share by investing a fixed dollar amount regularly, regardless of share price. Dollar-cost averaging is an investment strategy where an investor invests a fixed dollar amount at regular intervals, regardless of the security's share price. The primary benefit is that it helps reduce the average cost per share over time because more shares are purchased when prices are low and fewer when prices are high. It does not guarantee a positive return, nor does it attempt to time the market or only buy at lows. This disciplined approach removes emotional decision-making and is particularly beneficial for long-term investors aiming to mitigate the risk of investing a lump sum at an inopportune time.